Imagine, imagine losing $30,000 on Woody and Buzz Lightyear before the movie even hits theaters.
I mean, it sounds completely absurd when you put it like that.
It really does, because today, you know, for you listening, we aren't talking about massive buckets of popcorn or sold-out screenings or like the magic of the summer blockbuster. We are looking at the cutthroat, hyper-volatile world of financial leverage trading.
Which is definitely a completely different vibe from your typical Friday night at the movies.
Right. We've got this incredibly niche, frankly fascinating piece of source material in front of us. It's an article from June 2026, literally titled 2026 Box Office Race, a Leverage Trader's Guide. And our mission for this deep dive is to really explore how two entirely different universes, artistic pop culture and algorithmic quantitative finance, have just spectacularly collided.
And the battleground for this collision, right, is a platform called Polymarket.
Okay, so break that down for the listener.
Yeah, so for you listening who might not spend your days staring at financial charts, Polymarket is a decentralized prediction market. You aren't buying stocks in a company. You are buying contracts on the outcome of a real-world event.
Like betting on a sports game. Kind of.
Sort of, yeah. Every contract is priced between $0 and $1, and that price represents the percentage chance of that event happening. So say you buy a contract for the highest grossing movie of 2026 at 60 cents. That means the market believes it has a 60% chance to win.
Right.
If it actually takes the crown at the end of the year, that contract pays out a full dollar. And if it loses, well, it goes to 0.
Okay, let's unpack this. Because the people we're talking about today in this guide, they are not just casually throwing $5 down to guess what movie makes the most money.
No, absolutely not. They are using margin.
Exactly. And trading on margin is like, it's like putting a nitrous oxide booster on a sports car. It magnifies your speed and gets you to the finish line incredibly fast, but you are essentially borrowing capital to multiply your exposure.
Which means the risk is just astronomical.
Right. If you hit even a microscopic bump in the road, like a slightly bad review or a slow Thursday night,
Yeah.
the entire engine blows up and you lose everything. These traders, they're looking for moments where the current Polymarket odds don't accurately reflect reality, slamming that nitrous button and forcing a massive payout.
And the really crucial distinction to keep in mind here is that for a leverage trader, the raw probability of who actually takes the crown in December it almost matters less than the immediate direction of travel.
Wait, really? So they don't actually care who wins the year?
Not really. They are trading momentum. They want to buy a contract at 10 cents, wait for a trailer to drop or, a preview number to hit, watch the market realize the movie is actually a massive contender, and then sell that contract at 40 cents a week later.
Wow. So they just dump it?
Exactly. They don't want to hold the position until December. They are trading the volatility created by catalysts, real-life events that force the market to instantly reprice a movie's odds.
So let's dive into the immediate real-time battle happening right now in this June 2026 data, because we have a heavy favorite, Spider-Man, Brand New Day.
Yeah, the big anchor.
Right. It currently commands 62.5% of the market. And the logic for that high price tag makes total sense, Tom Holland is back in the suit for the first time since No Way Home, and that movie went on a mind-bending $1.9 billion run.
It was huge.
Massive. It has the Marvel-Sony partnership pedigree, a prime July 31st release date, and, well, an established theatrical ceiling that very few films can ever even hope to reach.
Yeah, Spider-Man really represents the benchmark here. In any prediction market, the front runner anchors the pricing for everything else. But the data shows something pretty alarming happening to that anchor right now.
It's bleeding, right?
Yeah, exactly. The odds are bleeding. Spider-Man is down 11 cents over the past month alone, shedding 8 cents just in the last week.
And this is where the mechanics of prediction markets get so ruthless. The source mentions traders panicking and selling off their positions. But if Spider-Man is such a sure thing with a $1.9 billion pedigree, the panic just seems irrational to me.
It does seem that way on the surface.
It reminds me of, like, a sports team that is up by 20 points at halftime. They are the clear favorite. But suddenly they miss a field goal, they fumble a punt, and even though they're still technically winning, the crowd just turns on them completely. The sentiment sours before the scoreboard officially flips.
That's a great analogy. And what's fascinating here is the mechanism driving that souring sentiment. It's called momentum divergence.
Momentum divergence, okay?
Right. So you have a front runner losing ground at the exact same time a challenger is rapidly accelerating. Traders aren't losing faith in Spider-Man in a vacuum. A new variable has entered the equation, and it goes by the name of Toy Story 5.
Ah, Woody and Buzz.
Yep. Over the past month, while Spider-Man bled out those 11 cents, Toy Story 5 surged from a 2% chance all the way up to 12.4%.
And the catalysts driving Toy Story's momentum are just staggering. The guide breaks down the numbers for its June 19th release. It pulled in $17.5 million just in Thursday previews, which is, it's the best of any film in 2026 so far.
Huge numbers.
Yeah, and it's tracking for a $160 to $175 million opening weekend, fueled by the massive double holiday demographic boost of Juneteenth and Father's Day. But the single detail that I cannot stop thinking about is the Rotten Tomatoes score.
Oh, the algorithmic trigger.
Yeah. The traders had predicted a 93.3% score based on historical tracking, but the film was certified fresh at 94%. We are talking about a microscopic margin, less than a full percentage point.
Well, to a general moviegoer, a 93% and a 94% are identical, right?
Completely. I wouldn't know the difference.
Exactly. But to a quantitative trading algorithm, that 0.7% beat is a massive mathematical trigger. These algorithms, they are built to scrape review sentiment, the literal second in embargo lists. Yeah, and they compare that sentiment to historical data for animated sequels. Because for a movie to become the highest grossing film of the year, a strong opening weekend isn't enough. It requires legs.
Right. It needs strong multipliers over weeks and months.
You got it. So when an algorithm sees a 94% instead of a 93.3, it adjusts its projected multiplier model upward. It tells the automated trading systems that word of mouth is going to be spectacular, meaning the mathematical floor for the film's total gross just expanded.
So it just buys.
Instantly. The algorithm executes buy orders on Polymarket before human traders even finish reading the reviews.
Which brings us to the leverage math, which is just wild. The source walks us through the actual financial returns of catching that algorithmic wave.
Yeah.
If you saw this coming and bought Toy Story 5 at 2 cents a month ago, you're sitting on an unleveraged 520% gain.
Which is incredible on its own.
Right, your contract went up sixfold. But nobody operating in this specific subculture is trading unleveraged.
No, applying leverage is how they extract meaningful alpha from these tiny market inefficiencies. So if a trader applies 5x leverage to that Toy Story 5 trade,
Yeah.
a $1,000 position transforms into over $30,000 in a single month.
$30,000.
Yeah.
Just from anticipating a tiny review bump. But on the flip side of that nitrous oxide metaphor we used, we have to look at what happens to the people holding Spider-Man. Because Spider-Man at 62.5% is still the mathematical favorite to win the year.
It is, yeah.
But if you bought Spider-Man a month ago at 73.5% on 3x leverage, the drop to 62.5 triggers something called a margin call. The exchange looks at the dropping value of your asset, realizes you don't have enough collateral to cover the borrowed money, and just forcefully liquidates your position.
They just take it.
Almost half your money is just gone, vaporized. And the movie hasn't even come out yet. The game is still being played, but your portfolio is completely wiped out simply because the market repriced the probability of the win.
Yeah, so if a supposedly safe bet like Spider-Man can wipe out 50% of your leveraged portfolio before a single ticket is torn, playing it safe clearly carries massive hidden structural risks.
Which makes me wonder about the exact opposite strategy. If the middle of the board is a bloodbath, going all in on the absolute riskiest plays might actually make more sense. Let's talk about the wild card, specifically the concept of maximum asymmetry.
Yeah, maximum asymmetry is a huge concept here. In quantitative finance, asymmetry refers to a setup where the potential upside of a trade is massively disproportionate to the downside risk.
So low risk, high reward.
Exactly. You are looking for a situation where you can only lose a tiny amount of money, but the mathematical possibility of an explosive payout remains viable. So we leave the relatively safe confines of franchise animation and look at the single-digit long shots.
And the poster child for maximum asymmetry right now, according to the guide, is Christopher Nolan's new film, The Odyssey. It is currently sitting at a 3.05% chance of taking the crown. And the early metrics outlined in the source are incredible.
They really are.
The trailer hit 121 million YouTube views in 24 hours. The BFI IMAX in London sold 28,000 tickets in a single day. And it's tracking for a $118 million domestic opening for its July 17th release.
But the core tension with the Odyssey, and the reason it's priced so low, is the structural cap of its rating. You have prestige, live-action cinema going head-to-head with superhero juggernauts, but the Odyssey is rated R.
Right.
Historically, an R rating places a hard mathematical ceiling on box office potential compared to a PG-13 film. You instantly lose the unchaperoned 13 to 17-year-old demographic, and that demographic is the engine for repeat viewings, which is, the primary driver of billion-dollar blockbusters.
Okay, I understand the historical demographic data, but didn't Nolan just shatter that exact model with Oppenheimer?
You did?
That
Yeah.
was an R-rated, 3-hour historical drama that crossed $900 million. I mean, he proved the ceiling is malleable if the cultural event is large enough.
He did prove the ceiling is malleable, but to take the overall 2026 crown, $900 million won't be enough. The winner will likely need to cross $1.5 billion.
Oh, wow.
Yeah, it's a big jump.
Huge. So the Odyssey is priced efficiently at 3 cents. It's a massive long shot. But this is the definition of maximum asymmetry per dollar. If you buy a contract at 4 cents, your upside to a $1 payout is 24x.
Right.
Apply 5x leverage, and your theoretical return exceeds 100 times your initial capital. It's a binary outcome. It either hits the cultural zeitgeist perfectly and you make an absolute fortune, or it performs like a normal R-rated film and you lose a very small initial stake.
For you listening, this brings up a really interesting psychological trap, especially when we look at the real bottom-of-the-barrel options, the sub-1% odds. Because the source lists a few that just look incredibly grim.
The lottery tickets.
Yeah, the lottery tickets. You have Wicked, for good at 0.55%, but that was a late 2025 release that already tapped out at $758 million. You have Star Wars, The Mandalorian and Grogu at 0.45%, which bombed with a franchise-worst $98 million domestic opening.
Right. And then there's the Hunger Games prequel, Sunrise on the Reaping, also at 0.45%, severely capped by historical prequel data at a $350 to $400 million ceiling. To me, it's the exact same psychological trap as buying a Mega Millions ticket when the jackpot hits $1 billion. The math feels intoxicating, but isn't this just throwing money away?
It is throwing money away. Quantitative traders evaluate these using probability-weighted expected value. They ask, does the tiny cost of the contract justify the microscopic chance of it paying out?
And I'm guessing the answer is no.
The answer here is definitely no. Even though a half-cent contract at 5x leverage returns 1,000 times your money if it wins, these are fundamentally dead assets.
Dead assets.
Yeah, the math requires catastrophic historical failures by every single frontrunner simultaneously. Unless a trader has insider information about a massive structural mispricing, tying up capital in these sub-1% lottery tickets is a trap. It's designed to drain liquidity from amateur retail traders.
Here's where it gets really interesting for me. The Super Mario Galaxy movie provides a perfect example of why this market is so brutal to navigate. Because the source points out that Mario opened to $372.5 million globally.
A monster opening.
A monster. It is rapidly approaching $1 billion total. By any normal metric, it is a massive cultural hit. And yet, its Polymarket odds crashed from 42% back in March down to just 4.05% today.
Yeah, and the underlying mechanism there is that Polymarket is a zero-sum game for the #1 spot. $1 billion is a spectacular box office result, obviously, but if algorithmic projections show Spider-Man tracking for $1.5 billion, Mario's actual probability of being first overall mathematically drops to near zero.
So if a $1 billion movie can wipe out 90% of your leverage portfolio, how does a trader even survive this? I mean, how do you avoid getting completely wiped out while your money just sits there waiting for December to arrive?
The survival mechanism is the catalyst calendar.
Okay, the catalyst calendar.
Right. Sophisticated leverage traders rarely employ a buy-and-hold strategy. Holding a leveraged position costs money in the form of borrowing fees. And worse, it exposes you to massive downside risk if the cultural narrative shifts against you while your capital is locked up.
Like we saw with Spider-Man.
Exactly. Instead, traders position into catalysts. They identify the specific dates when price discovery is forced, like a premiere, an opening weekend, or a review embargo lifting. And they sit in cash until right before that event. They trade the immediate volatility, and then they exit the position.
Let's walk through the key dates the article lays out, because this serves as the real roadmap for the rest of 2026. First, we have July 17th. That's the Odyssey's wide release.
A big test for Nolan.
The ultimate test of the R-rated ceiling. If Nolan's film opens above $130 million, the algorithms will instantly reprice the entire board, draining percentages from the superhero films. And then, exactly 2 weeks later, we hit the decisive moment, July 31st. Spider-Man. Brand new day.
Spider-Man is the hinge point for the entire market's liquidity. The projections show it needs a domestic opening north of $180 million just to mathematically justify its current 62.5% position.
So it can't just be good, it has to be perfect.
Right. It has to overwhelmingly reassert dominance to push its odds back up into the 70s.
And if it comes in soft, say under 150 million, the algorithms will trigger massive sell-offs. The traders who shorted Spider-Man and rode Toy Story 5's momentum are going to cash out with unbelievable leverage multipliers.
Oh, yeah, they'll make a killing.
But then we have to look ahead to December. The source refers to December 18th as Doomsday.
Great name.
It is. You have
Yeah.
Avengers. Doomsday sitting at 11.5% odds right now with an estimated baseline floor of $1.2 to $1.5 billion. That releases on the exact same day as Dune, Messiah, which is down at 0.6% odds. The audience cannibalization here is just fascinating.
Two massive blockbusters opening at the exact same time.
Right. You have two highly anticipated spectacle-driven films opening simultaneously. They're going to fracture the premium large-format screens, like IMAX, and split the opening weekend audience. That suppresses the opening numbers for both of them, potentially taking them both out of the running for the top spot entirely.
The audience cannibalization is a massive fundamental risk, but there is a secondary, purely financial risk for the leverage trader regarding December, and that's the concept of opportunity cost.
But wait, I have to challenge that. You mentioned earlier that tying up capital for months exposes you to risk and borrow fees, but if you can lock in Avengers, Doomsday at an incredibly low 11.5% right now in June, isn't that essentially the safest value play on the board?
You'd think so, right?
I mean, why chase volatile summer catalysts with Spider-Man or Toy Story when you have a guaranteed Disney juggernaut waiting at the end of the year? Isn't buying the dip on Avengers the smartest move?
It seems logical, but in the leverage trading environment, opportunity cost destroys value. If you use your margin capacity to buy Avengers in June, that capital is illiquid for 6 months.
Ah, so you're just stuck.
You're stuck. You are paying daily borrowing rates on that leverage. But more importantly, you are missing out on the explosive volatility of the July catalysts. A trader who keeps their powder dry can deploy their capital into the Spider-Man catalyst, make a 300% return in a weekend, and then roll those profits into Avengers in November when the picture is clearer.
Wow.
Yeah, tying up margin for half a year in a prediction market is considered dead money because the capital velocity just drops to zero.
So what does this all mean when we step back and look at this 2026 box office race? Through the lens of this guide, we aren't really talking about movie reviews, artistic merit, or pop culture supremacy anymore.
Not at all.
Whether you were analyzing Spider-Man's franchise pedigree, writing Toy Story's mathematically proven momentum, or hunting for maximum asymmetry with Christopher Nolan's R-rated epic, the real lesson is about the mechanics of perception. These financial traders are viewing cultural milestones entirely through the lens of raw probability, market catalysts, and algorithmic leverage.
And if we connect this to the bigger picture, it reveals a fundamental truth about information markets that applies far beyond just the summer box office. The absolute worst approach you can take in any highly efficient market is entering after a catalyst resolves.
Because it's already too late.
Exactly. If you wait until the Monday morning after an opening weekend to buy a Polymarket contract based on a spectacular box office number, you've already lost. The algorithms ingested the Friday preview data and repriced the asset 48 hours before you woke up.
Your edge is gone.
The edge is completely gone. Knowledge is only financially valuable when it is applied at the precise right time, anticipating the catalyst rather than reacting to it.
It brings me back to where we started. For you listening, think about how you usually experience the movies. It's a shared cultural event. You sit in the dark, you eat your popcorn, and you experience a story alongside a crowd of strangers.
The classic moviegoer experience.
Right. But if we start looking at art and pop culture purely as volatile financial assets, things to be heavily traded on margin based on a 0.7% algorithmic deviation in a Rotten Tomatoes score or a Thursday night IMAX sellout, does it completely change what it means to be a fan?
That's the real question.
Are we still an audience emotionally investing in a narrative together, or are we slowly being trained to become cultural speculators, quietly watching our portfolios bleed out before the opening credits even roll? That is something to mull over the next time the lights go down in the theater.